Welcome back. You're watching the Mutual Fund Show. Now, the large and mid-cap category of equity mutual fund schemes is what we're talking about. And we were in conversation with the PGIM CIO to talk about the NFO that they have on offer. Now, there are several schemes that are currently in the market and available right now. And in fact, there are assets worth about 1.88 lakh crore that are being handled already by these schemes. We've gotten you a bit of insight of how these schemes are supposed to be managed, but then there's a lot more that you need to take into account before you decide to add this into your portfolio. To talk about where it fits and to talk about the various pushes and pulls related to managing such schemes, I've got Mrin Agarwal, financial educator and founder of FinSafe India, and Himanshu Kohli, the co-founder of Client Associates, joining in on this conversation. Thank you to the both of you for taking the time. I will start with you, Mrin. We won't start immediately with PGIM because I'll come to that in just a bit. But on this category, and my last question to the PGIM CIO, it's supposed to be giving you more alpha than a large cap actively managed fund, and it's supposed to protect downside comparatively more than a mid cap or a small cap fund. Is that how you would describe it? Where does it fit in a portfolio?
So good afternoon, Alex. Yes, ideally one would describe it like that. And I think this sort of a fund is really meant for investors who want to have exposure to both large and mid caps in one fund itself, so that they don't need to do the asset allocation themselves. And they have primarily decided that they want to do large and mid caps. And of course, they want the active management as well. So based on these three factors, this sort of a fund could work for them.
Fair point. Himanshu, I'll come to you on this one. Traditionally, when we talk about asset allocation, you generally talk about a core and a satellite portfolio. I mean, various versions of that same conversation, right? And we have talked about, the benefits of having a core portfolio, which is large cap, which is passive because of the cost involved and because of the inability of fund managers to beat the benchmark. Where does a large and mid cap fit when you look at that core and satellite allocation portfolio strategy?
So Alex, large and mid cap will be a part of our core strategy only, because we have in our core pure large cap funds, then pure mid cap and small cap funds also, and then there is a space for multi cap / flexi cap. So large and mid cap will fit in our core strategy over there.
But delving a little deeper then, if you are to add, Himanshu, a large and mid cap into your core portfolio, is it in combination of other things? How do you approach this?
So we look at, Alex, quite a number of things when we add a portfolio as a part of our model portfolio. One, the vintage of the fund manager, the pedigree of the fund house, also the track record which the scheme has. So a lot of times, Alex, investors look at NFO more like an IPO. There is a huge difference, because today if someone invests in an NFO, it is like entering the Sensex at 72,000 or Nifty at 22,000 levels or midcap at 39,000 levels. It's not investing something which is available at 10 rupees, which means it's at a discount. You're entering at the fair market valuation of a particular scheme. Now, whether you invest in an old scheme which may have an NAV of 40, 50, 100, whenever the scheme was launched, respectively, or you invest something which is new at available at 10. A lot of times clients do mistake that NFO is available at a lower price, which is 10 rupees, which is a huge misconception. So we look at the historical track record, what's the alpha creation ability of the fund manager, consistency of that alpha, Sharpe ratio which the fund manager has delivered time and again, what is the rolling 3 years, 5 years returns which these funds have delivered, what is the outperformance they have delivered compared to the respective benchmarks which they are following. So that's how we actually construct the model portfolio schemes for us, for our clients.
Fair point. Okay. Mrin, in the data that you've shared with me, there is a very interesting table that I see in front of me, and you've actually compared various categories of mutual fund schemes in the equity category, of course. You've looked at large cap across categories, you've looked at mid cap, large and mid cap, small cap and multi cap. And you've done, let's take it in two parts. So the first one is rolling returns, and you've compared the two. What are the insights that stand out when you look at inter-category comparisons?
So Alex, the idea of sharing this table was to exactly show you this, that if you were to go in, if you were to go for the fund separately versus if you want to go for this fund together, right? And there's always this, especially for DIY investors, there's always this dilemma, whether you should do the two funds separately or whether you should just do one fund itself. So remember, of course, in this fund, there is this 30% that the fund manager has, which they can, of course, deploy the way they want to. And I would say that, somewhere for me, I would still try to compare it and see how does this stand up to a multi-cap, right? So, of course, multi-cap is 25% each in large, mid, and small cap, whereas large and mid-cap is 35% in large cap, 35% minimum in mid-cap, and then 30% the fund manager has the flexibility. Now, if you actually look at the rolling returns, which is, of course, the right way to look at returns, and here we've taken monthly average rolling returns in a 10-year period. So we've looked at 5 and 7-year returns. And you find that there is not that much of difference, honestly, between the large and mid cap and between the multi-cap space. So again, it really comes back, if you ask me, to what investors find more convenient. Do you want to do this separately? Because if you invest separately, obviously you have to be very clear about what is the sort of allocation that you're going to be doing between large cap and mid cap, or do you find it convenient to just buy a fund where this allocation is done for you, right? I think what the data basically shows is that if you're choosing this fund, you're looking at somewhere a number in between the large and the mid cap returns.
Which ultimately is what we're trying to do as well, right? So the downside is what comes into play. I do want to very quickly delve into that with you as well, because that's the second half of the table that you've shared, which is the down capture ratio. As I understand it, this is measuring how much an actively managed fund falls when an index falls. Is that the correct way to look at it? Yeah. So how do you describe the various categories?
So again, I was actually surprised to see the number myself for mid caps being lower. But again, I just feel that, this is just one of the volatility ratios. I mean, honestly, there are so many other volatility ratios that one needs to look at. And, this cannot be looked at in isolation. Of course, you need to see upside capture ratio and many other ratios that Himanshu was also talking about, many other factors. But again, all I'm trying to show is that somewhere, with this fund, what you're getting is something in between always, right? It's neither on one side, neither on the other side. So again, it really comes back. Again, I know I'm repeating myself, but it's really coming back to the whole convenience aspect, right? Do I want to do it this way or do I want to do it in a split way?
Fair point. Himanshu, I know I kind of asked you this question, but assume we're talking about an average investor that has stayed in the market for some time. And I know that a lot of advisors like yourself say that when you want to cut your teeth, you kind of look at your passive strategies in your large cap category, you spend a little time with the market, you understand how it moves, and then you move and you diversify, right? Assume that you have a little bit of nuance when you're approaching your portfolio and you've got a fair idea of how much large cap, how much mid cap, how much small cap should be in your portfolio. Do you then get into the portfolio construction of a particular large and mid cap scheme and say, okay, if my overall portfolio allocation has to be this, I adjust the rest of the investments accordingly?
Right, Alex. So one of the most important constituents for success of any investor is the strategic asset allocation. This could be broader at different asset class levels, how much in equities, how much in bonds, how much in property, how much in alternates. Within equities also, you could also further have a formula, how much should go towards large cap or mid caps or small caps. Now, there is a very interesting formula which we have designed, which at certain points in time says one needs to be slightly overexposed to a particular category within an equity. So for example, today, against our normally 60% exposure towards large caps and 40% towards mid and small cap, we are more towards 65% towards large cap and 35% towards mid and small cap. Once we have decided this, then we get into the construction of the portfolio. How much should one go and purely buy large cap managers, whether it is through mutual funds, index funds, or PMSs or AIFs. Similarly, from the mid and small cap, how much towards purely mid cap managers or small cap managers. And then there are something which is for multi-cap, which could be multi-cap managers, flexi-cap managers, or large and mid-cap managers. This is how we get into the construction of the portfolio. And then each of these buckets, we look at various parameters, the performance, the Sharpe ratio, the expense ratios, which each of these managers are showing or having, what's the alpha creation ability of the fund manager on a historical rolling basis. So that is how the overall, it's a top to down bottom approach, which is what we look at while constructing the manager selection process, which is what we call as the model portfolio for our clients.
Got it. Got it. Very quickly then, 65% towards large caps is the current scenario. I'm curious, are you advising any amount of cash right now?
So as per our model, the markets are slightly overvalued. If we just talk in terms of P multiples, it's overvalued to the extent of 4%. But we use certain other parameters besides P multiple, which is price to book, market cap to GDP, and the yield gap ratio. As per that, the market is overvalued to the extent of 16%. So if someone, Alex, is a 50% equity investor, as per our holistic model, one should be today 42% invested, 8% sitting in cash, and that 8% one can just systematically get into the markets over a period of next 8 to 16 months, whether it is 1% per month or 0.5% per month, depending on the profile of the investor. So right now, consuming less of equity, as per the mathematical model, makes slightly more sense.
Okay. And thanks so much for spelling that out for us. Mrin, I'll come back to you with the original conversation about PGIM India's NFO in the context of everything that is available in the space. What is your view on a new strategy like this, not tried and tested? What would you pick if you were asked which large and mid cap scheme should I look at? How do you narrow that down?
So firstly, actually, I always believe that it's, better to do these allocations separately. I think, these funds work for DIY investors who, do not have the luxury of having an advisor advise them. But as an advisor myself, I would say that, always do it separately. But yeah, I mean, if you are doing it through this fund, through a large and a mid cap category, again, as you know, Alex, I've never been in favor of NFOs. When you have enough funds with a lot of history and with data that's available, I would still prefer an existing fund, even if you want to take allocation to this category. So as such, I'm really not in favor of NFOs.
Fair point. So therefore, with the ones that have a reasonable history, are there any that you like in the category?
Well, of course, Canara Robeco has been probably one of the good performers. Quant has been doing pretty well. Kotak, TSP. These are some funds which, again, when I look at rolling returns and again look at capture ratios and other parameters, find that these funds have been consistently performing. Okay,
Himanshu, last view with you. I guess you have a similar view to Mrin on the large and mid cap category. But if I were to push you to say, are there any that you like in the category?
So I would say yes, there are quite a number of them who have a rolling track record and they have created an alpha. So some of the names are very common, like what she has mentioned. It is Quant, Kotak, for example. They have been able to create alpha. So these are some of the ones, like Mire is also another one in large cap. I really like them. Then there are certain boutique houses which runs PMS or AIFs over there. For our larger clients, HNIs, UHNIs, we prefer a lot of that also, which could be white space alpha or a Bacchus.
Got it. Got it. Himanshu as well as Mrin, thank you so much for joining in on this conversation, and always a pleasure speaking to the both of you. Viewers, that was all about large and mid-cap schemes. And by the way, there's a number that has been playing on your screen, on the bottom of your screen. If you've got questions for us, related to mutual funds, and you can write to us on that number, and we'll take it up on an ongoing basis through the week at 1:30 p.m. Do stay tuned, lots more coming up over the course of the day, and this is NDTV Profit.